All right, I guess we'll go ahead and get started. So welcome to the webinar on transition planning. This webinar is brought to you by Career Management Partners and Yield Financial Advisors, and we appreciate your attendance today and hope you find some valuable information in this webinar. Who is? So I'm Wendell Brock. I'm a chartered financial consultant, a principal at Yield Financial Advisors. I have a bachelor's in financial planning and counseling, married with 6 kids and 1 grandson, and life is great. I probably sound a little bit funny today. I think the allergies, the fall allergy season has really hit me, and it's hit me hard, and so I've just been kind of a little bit overwhelmed with it this fall. But anyway, we'll get through this. So financial planning, I think before we really get started into it, let's define what financial planning, what that term means. Generally, it means the wise use of your assets to help you make the maximum use of every before and after tax dollar. And that may seem a little bit basic, but that's really what it's all about, is how do you make the wise use of your dollars and make your dollars stretch and accomplish all the things that you need them to and want them to accomplish. Good financial planning will help you take advantage of your earning years so you can truly have some golden years. And that's really, I think, one of the big ideas of it is to make sure that you have a future, that your future is secure, your tomorrow is secure. Financial planning is really for everybody. If you really think about it, whether you're rich or poor, it doesn't matter. Going through the process of working through your finances and understanding them better and managing them better will help you secure a good future. And that's what we want to do today, is just kind of go over some of the basic principles, particularly when people are in transition, as to what they can do to make sure that their financial house is in order, so to say. So 6 reasons people fail financially. Number 1 is always procrastination. People just seem to think, oh, I can take care of that later, or excuse me, or it's not a burning issue right now, so I can deal with it in the future. And that becomes a real problem. As we go through life, the cares of the world will always be there. But the reality is that your best advantage to preparing for the future is now, so that you have the most time on your side. Time is of the essence, and time is the big thing there that really helps people in their planning. So what are some of the reasons people delay? End of the year, start of a new year, working through Christmas issues, spend too much, income tax season, kids get out of school. These are all things that come up every single year. They get out of school, you have vacation, you have graduation, you have back to school, you have holidays, Christmas breaks, and then you're back at the end of the year again. And so the cycle repeats itself. And every year people have these same excuses. Well, I can't get together right now because it's tax season and I'm just too swamped, or it's the end of the school year and the kids we're just too busy with things. And so it always ends up being that they procrastinate, and soon enough a year's gone by and you've lost that year of putting things to work better. The other thing to think about too is even your age. Young people think, obviously, that there's always a tomorrow and they'll live forever. And so at age 25, they're newly graduated and they're thinking, well, we can't accumulate money right now. We're just getting started. We don't make a lot. We're pretty tight, and we're entitled to a little fun while we're young. And besides, we have plenty of time. We're 35. Our family's growing. Our mortgage payments are high. Once the children are older, it'll cost less. Then we'll begin to invest. We can't save a nickel right now. We're 45. 2 children are in college. It's all we can do to pay their expenses. It seems to be the most expensive time of our lives. We're 55. We know we should invest, but things aren't breaking like they used to. At our age, it's tough to start new careers or get a better job. We'll have to sit tight right now, and maybe something will break. We're 65. Who, us? Sure, investing is a great idea, but we're 65 and Social Security doesn't go very far. We should have started years ago, but it's too late now. And so those are the typical things that people use as excuses for procrastination, and it's amazing. And then the other element is that there's really a cost of procrastination. So to save $100,000 at age 65, assuming an 8% compounded return, at age 25, you'd only need to save $29 a month, or $4,603 in a lump sum. At age 35, it jumps to $68 a month, more than twice the amount on both of those scores. At age 45, it's $170 a month, and to save that same $100,000, a lump sum would be $21,455. So in 20 years, it's gone up by nearly 5 times the amount. And then at age 55, age 55, it's $547 a month. So 3 times the amount here, and again, over twice the amount there in lump sum. So yes, there is an actual cost to procrastination. And you want to be, that's why I said at the very beginning, is time is on your side. The earlier you get started, the far better off you'll be. The next reason people have difficulty is failure to establish a goal. I work with a lot of people, and many of whom have never really thought much about what it takes to make things work in the future. They didn't create any goals using a budget to better manage their cash flow and savings and investments. If there was money in the account, it was there to be spent. Once they spent what they wanted for the month, if there was anything left over, they would save it. So what we want to do is switch people from the perspective of save and spend, how people save and spend their money. To be successful, you really need to save first. And so in this scenario, using a budget really shouldn't be restrictive. It should free us up to accomplish our goals, because using a budget, you're pre-deciding how you're going to send your money to work, so you don't have to make those decisions 2 and 3 times, particularly when there's a sale or something like that pops up. Because everybody's out there making sales, trying to get you to buy the one item that they think you really have to have that you really don't need. So that's also another big thing, is understanding and clearly defining the differences between needs and wants, and making sure that those needs and wants are covered properly. We do this, one of the things we do is do this by assigning each dollar to perform certain tasks. When we make these assignments, we stick with them, and we try not to change those things. Now, obviously, things can change on a monthly basis, and you need to make some changes, but the overall concept and the overall structure of it doesn't change. It doesn't mean that we do without, and so we may spend money as well, but we balance the understanding of needs and wants, and we focus on the needs first, and then what's left over gets used for the wants. While in transition, cash flow is critical. And so how much can you live on versus what you normally live on? And understanding those differences again. Proper structure of debt elimination and strategies to pay the debt and getting the debt paid off. It's extra hard on families when they're in transition and there's a pile of debts to be paid. If there's any way to get those debts eliminated, then your transition can be a lot smoother. We can do two things with cash flow. We can cut expenses, which only works so much, and then we can increase our cash flow. And that's limitless. We can increase our cash flow to whatever we can dream and work and put together. And so that element becomes a very big part of what we do in our planning, is how do we increase cash flow and use our expenses wisely. So setting the financial goals and save and spend. And this concept, most people, I would venture to say in the United States or even in the world, they get their money and they spend a little bit, spend a lot of it, and they save a little bit of what's left over, if there's anything left over. Because whenever we get our income, we can always justify what our expenses are and where we spend money. We can always justify that. And so that's not a big deal. But what we need to do, what the stronger financial position to do, or what will build the greatest financial strength, is to save first and then spend what's left over. This forces you to really put together and think through how you use your money, and it makes you overall a more wise steward over how you use your money. And so you want to be in this category of save first and spend what's left over. And people always ask, well, how much do I know how much to save versus how much to spend and things like that? And that's different for everybody. But generally, you know, this is 4% is just based on what the average in the United States is that people save, and we know that they save way too little for their futures. And so so the idea, you know, generally you're looking at, if you're young, you're looking at around 10%. If you're a little bit older, it could be 20 or 25 or more percent. And so you really need to balance that with what the goals are and how quickly you want to accomplish those goals. Understand the rule of 72. That's an important concept as well. Or excuse me. Oops, sorry, I apologize. I skipped a slide. Here we go. Ignorance about what money must do to accomplish the goal. And so we set a couple of financial goals in number 2, and now we're going to talk about the ignorance about what money must do to accomplish that goal. So understanding the rules of 72 is an important thing, because this just basically gives you a thumbnail concept about how money works. And you can generally, every time, for some reason, 72 is kind of a magic number. If you take 12 and divide it into 72, you're going to get 6. And so at 6%, given 12 years, it'll take that much time for $10,000 to double to $20,000. Or you could reverse it and say at 6 years, if I was earning 12%, my money would double in 6 years' time. So that's basically the concept. Whatever you divide into 72 will either equal the interest rate or the years as to how long it would take for your money to double. And it's kind of a cool number, cool rule of thumb there. Failure to understand and apply our tax laws. Quite often taxes get in the way of everything that we want to do. It's just so darn expensive to pay taxes. By golly, I mean, there are people out there that pay hundreds and hundreds of thousands of dollars in taxes, and there are people that don't pay any. So, but the advantage is to understand the tax laws and use them to your advantage. The tax laws don't discriminate against anybody. They only discriminate against the ignorant that don't use them. Judge Leonard Hand, back in the 30s, made this comment in a tax case: anyone may so arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. There is not even a patriotic duty to increase one's taxes. Over and over again, the courts have said that there is nothing sinister in so arranging affairs as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do it right, for nobody owes any public duty to pay more than the law demands. I think that's a positive thing, that we arrange our taxes to pay the least amount possible, and that's very important. And so how do we do that? Well, we get some education about taxes and about our cash flow and how that works. Understanding the wipe phenomenon is a great place to begin. What you have to earn. What do you have to earn in order to spend $100? That's always an interesting concept, and very few people understand this. But a lot of people think that if I want to go spend $100, all I have to do is spend $100. But that's not the case. If you're in the 28% tax bracket, you have to earn $155.40 in order to spend $100. That's because before you have that $100 to spend, you have to pay 7.65% FICA and Medicare tax. You have your 28% tax bracket, total tax of 35.65%, and then that becomes a divisor. So 1 divided by 64.35% equals $155.40. So that's what you have to earn in order to have $100 left over in order to spend that $100 on whatever. I remember as a lad helping my mother in my teenage years. My mother quite often we would sit down and she would review the family income taxes with me after she and my dad put them together. And she would, in her patriotic mode, send in an extra $50. And inevitably, every year she would get a letter back from the IRS saying, "Mrs. Brock, you overpaid your taxes, and here is your refund of $50. And they would never keep it. And so finally she kind of got the message and decided to stop doing that. But the thing is that they don't expect you to pay anything more than what you owe, and they'll send it back. And so arrange your affairs to make it so that you're paying the least amount in tax. Money buckets and taxes. So cash savings accounts is the first bucket, and these first 3 buckets are generally funded with after-tax dollars, which makes them easiest and the least costly to get cash from. The last bucket will cost us much as much as 50% to get money from. This makes the needs to get more money from this bucket critical in nature. So in the first bucket, cash, checking, savings accounts. Second bucket, CDs and liquid investments. Third bucket might be life insurance, cash values. And the fourth bucket, it would be retirement accounts and annuities. And so that's the last bucket that we want to get money from, if at all possible, to stay away from that. Because anything we pull out of that, we're going to have, if we're under age 59 and a half, we're going to have a penalty tax of 10%. And then we're going to have to pay the regular income tax on that. Excuse me. So again, if you're in the 28% tax bracket, you can end up paying 38% on that one $1,000 that you may pull out of that account. So that could be the very last place you want to go and pull money from. And then we may have some custodian money and things of that nature that we may want to transfer from a 401k to a personal IRA. And so what we can do there is we can transfer it, but we have to be careful in how we transfer that, because we want to make sure that we keep it custodian to custodian in that transfer, so that we don't pay a tax on that money. We don't want to pay a tax on our retirement dollars. We want to keep that good and free. So when we move the money, generally 401k plans use a bunch of mutual funds as their primary investment vehicles. By moving the money, we have access to thousands of other investment choices that you can control. And so generally there's only maybe 10 to 20 or 30 mutual funds that a 401k would have access to. But by moving the money and putting it in your own self-directed IRA bucket, you can have thousands of options. You can help manage those funds. We can help you manage those funds and customize a portfolio that would be more personal and personally designed just for you than something that that may or may not work well in just a 401k. So that's one of the great reasons of using that. But you want to be careful in moving that. So moving assets directly from the 401k to yourself and then to the personal IRA bucket can cost you a chunk of money. So how that works is you're allowed one rollover for all your accounts in a year. When you get the money for 60 days, then put it into a new IRA. However, on this rollover, the 401k company has to withhold 20% and send it to the IRS. So you get 80%. If you complete the rollover and roll it into a new IRA, and you have to roll over the full amount, the full 100,000, then you can apply with your tax return to get the 20% return to you. So that means basically, if we're talking about $100,000, if that was our number as example, then the 401k company is going to keep $20,000 and send it to the IRS, and then you have to put $100,000 into the account to get the $20,000 back the following year on your taxes. And so it's not a very good fix for that. So the other is, number 5 is failure to properly prepare for the unexpected as a problem point that people have. And so what happens in this situation is the unexpected. Life happens, and so we have medical insurance. This is the company benefits. We have medical insurance, dental, vision care, group life, group disability, flexible spending, etc. And so those benefits, they don't transfer with your job loss. So how do you take take care of those. And part of the challenge too is, for example, I've got a client that while he was working and doing fabulous in his job, he developed some health issues that would prevent him from getting life insurance. And then he loses his job, and all he had was group life insurance. He didn't have any personal privately owned life insurance or privately owned disability insurance. It was all just group through his employer. And so at that point, he lost those benefits. And now if something happens, his family is stuck. So that becomes a real serious problem. So you want to plan with your personal benefits. Think of it as your own little personal company benefits. Have your own life insurance, your own homeowner's auto insurance and disability insurance, and make sure that those are at the proper levels, and maybe even an umbrella policy as well if you're in a more high net worth scenario. And then, of course, the other part of things that happen is an estate plan. You have wills, durable power of attorney, healthcare directive, living wills, HIPAA directive, etc. All of these documents are critically important to an estate plan and to life in general. And those are especially important if you have children at home, or even if you don't have children, just period, they're important, because you don't want to be in a position where someone is making those decisions for you that you don't think should, that normally you wouldn't select. Number 6, failure to develop a winning financial attitude. This one is a personal thing. We all determine our own level of success in a lot of ways, and so we have basically, it's up to us as to how we react and respond to things. There are basically 2 phases of life. We have an accumulation phase where we're acquiring assets. Excuse me, and then we have a distribution phase where we're starting to spend down these assets. And so on the accumulation phase, we're accumulating a mountain of assets. Our 401ks, maybe some rental properties, our IRAs, things of that nature to live on in our distribution phase. And so as in mountain climbing, the tools you use to go up the mountain are a lot different than the tools that you use to go down the mountain. And most accidents in mountain climbing happen on the way down, not on the way up. And so that proper planning and preparation is critical to to making things work right. And so so the tools we want to gather as we head up the mountain are important. And then periodically we may have a job loss, illustrated by this little hump right here in the mountain, where we may end up coming down the mountain for a while before we really start going back up. So having that winning attitude is really important. You'll determine your success. Excuse me. While I have shown you a few financial ideas and explained some concepts, you must approach your financial path with determination and persistence. I can't say enough about how important persistence is in this. Self-reliance and financial independence can be your future with some additional knowledge and work. The whole concept of being self-reliant is so important. This is something you have to decide. You have the agency to choose how you're going to move forward. Are you going to put the tools in place to make that descent down the mountain easier? And so those are all so important. How are you going to move forward? And how are you going to move down that mountain? That winning attitude, there's the old saying of rats, now it just escaped me. It's something like, if you always do what you've always done, then you'll always have what you've already got. That's the saying. And so if you don't make any changes, in the terms of this last question, what are you going to do differently? If you don't make any changes, then what's going to happen? There's not a lot to do. What does it take to make this work? Generally, there are three things that we work on. We try and develop the faith and vision to improve our winning financial attitude. We have to exercise self-discipline. It requires a self-discipline to do the saving. That commitment is so critical. And then we have to make a commitment, and that commitment is something that's a commitment you can't break with yourself. You have to be strong on that commitment and make sure that everything works, and that's so important. The process, we basically go through a 5-step process as a planning firm. We gather personal information, we do a plan preparation and determine the tools that would best help you accomplish your goals, and then we present those findings to you and provide you with a completed financial plan. And then we work on plan implementation to create a to-do list and start implementing the tools. And then we monitor that plan on a regular basis to make sure that that everything is going the way it should, because things do change and events and occurrences happen. And so to the extent we can monitor that, we can help you stay on the right track and keep you headed in the right direction. How to get started? You could text Yield FA to 44222, and that'll prompt you. You'll get an information booklet that we can use to assemble your financial plan. That'll give you also a risk profile questionnaire and a document for list for our first meeting, and those are generally the documents that we would gather in our meeting to help understand where you are currently at. And then we will go to work on our part. We'll call you and put some information together and get some ideas from you as well. And maybe if you're in the Dallas area, we'd meet in person. And then we'll put together the plan. If you'd like my effective budget spreadsheet, you can email me at www.brock@yieldfa.com, or if you have any questions, then please feel free to give me a call. We greatly appreciate your time and interest in our little webinar here, and we hope and wish you the absolute best in your transition and in finding new work and keeping your finances together in a successful manner so that you're able to stay on track and reach those retirement goals. And so I thank you again for your participation in today's webinar, and wish you the best of success in all that you do. Thank you, and goodbye.